So my next guest notes that we're in the 30th month of a cycle favoring low-quality names. And your typical cycle usually lasts 22 months. So that means maybe it's time to start broadening out your positions. I'm going to bring in Washington Crossing Advisors Co-Chief Investment Officer, Senior Portfolio Manager, Kevin Caron. And, you know, Kevin, it's a lot of people fretted about this, the low-quality risk. You put it out there, junk rallies, enormous volatility, and brutal pullbacks. But when we're in the middle of them, they've worked out so well for people. So the transition to get out of these names and to something else, what are you telling your clients?
Well, this is a cycle that plays out like a pendulum. And when we say low quality at Washington Crossing, we're talking about low debt, profitable assets, and consistency. And the last few months, the last 30 months or so, it's not been about that. It's been more exciting stocks, more risk-oriented stocks, and very high valuation stocks. But this pendulum does swing. We're 30 months into a cycle that usually only lasts 20 or 22 months. So we position a little bit more defensively here, especially given a lot of speculation that we see out there and some very high valuations, particularly among lower quality names.
So secured overnight financial rate has plunged. You couple that with reopening the government, the Treasury account, the $1 trillion. The notion is that maybe there's going to be an avalanche of liquidity, and that might keep that low-quality rally going.
Well, where the liquidity comes from are investors themselves. So if you look at where credit spreads are today, that's indicative of investors that are very willing to inject liquidity through lower risk premiums into the market. So there has been a lot of liquidity. The question would be, okay, now that it's already ample, what if it dries up a little bit?
Let's talk about this low-quality, high-quality dynamic, okay? Because this is a chart you had in a table you had in your October newsletter. Explain to us, the pendulum.
Yeah.
It starts to swing back. I guess it gets momentum, and you really want to be now in these high-quality names as this pendulum is swinging.
Yes. So in conclusion, when you look at this over a full cycle, both the rabbit and the tortoise have their day. And we have been in a lower quality cycle since 2023.
Right.
After rates were raised and the stock market came down hard, that gave low quality a chance to get up off the canvas and run. And that has happened for about 30 months, and you can see that lower quality stuff has led the day. High quality stuff, our A quality index at Washington Crossing Advisors, is only up about 2% year over year. So there's no interest in the kind of more defensive kind of names that represent A quality. But when the pendulum swings the other way, you really want to be focusing on these high quality names, because look at what you have. The last 4 cycles you had in a high quality cycle, this would be a little more risk-off kind of environment.
Right.
A quality actually went up. In every single case, low quality went down, sometimes significantly. So we want to be a little careful here about quality.
Now, where are you with dividends? Because you do have a dividend fund and a dividend offering at your firm.
Sure.
And I'm trying to get the chart here. So I keep thinking that this is where people want to be, and I think we'll see a lot more action toward that as people come out of money markets. They're not there yet, right? Yeah. But what are you telling folks about the importance of dividends in the long-term portfolio?
It's not the yield. In fact, if you grab for high yield, you're likely going to end up with low quality. So we don't recommend high yield at Washington Crossing. Right. What we recommend, though, for if you want to look for quality, look for growth in the dividend. And so over time,
so dividend growers is what you're really focused on.
Is more about what's going to lead to quality. And so if you're interested in quality companies, more defensive kind of characteristics, and also a rising stream of income, that's where you want to go.
So let's talk, because we're still in this environment where all the momentum is still with this sort of mega cap names and tech names, and even though they've hit a few bumps in the road, you're saying there's still a quality approach there. Yeah,
so Washington Crossing, we want to have a foot in both camps.
Okay.
So AI is very exciting new technology. It's going to transform the world. It's going to transform industry. We recognize that. But remember, in the 90s, when the internet really took off, what did we know about? We knew about Netscape. We knew about AOL. We knew about Sun Microsystems. Those names didn't ultimately end up winning the day. And what we want to do is make sure that we're invested in companies that are today generating cash flow. And then in the future, as we go through this process of introducing AI to the economy, we may have tremendous opportunities to invest in companies that don't even exist yet.
Right.
But this is where we would go for a combination of quality.
Oracle, Microsoft, Amphenol, Google, and Cisco.
Yes, sir.
Thank you very much.
Charles, great
Always
to see you.
appreciate you, Kevin. Thanks a lot.
Thank you.
All right, folks. So